All right, Thursday, March 26th. It's day 3 or day 4 of my coronavirus update. Here we go. Let me take this thing. A lot of news, a lot of stuff going on. A lot of things I want to talk about. All right, first of all, I'm sure everybody saw the weekly unemployment claims today of 3.3 million. That was 5 times the previous record, which was back in 2008 or 2009. So 5 times. I mean, if you look at that thing on a chart, whereas before, it was like a 10-year down cycle of shrinking weekly unemployment claims, and now it looks like it was like a flat line and that thing just like a moonshot. And that's just the beginning. We're going to get more of that. However, market up 1,350 points today. I called the bottom a couple of days ago last week. We were buying down there. What was it, Monday or something like that? Look, there's still a lot of fear. A lot of fear. The market, and I had this conversation the other day, the market, and some of my subscribers got a little annoyed with me today because they're like, I kept saying, buy the dips, buy the dips. We had a chance to buy the dip overnight. I think in the morning it opened up kind of weak, and then it rallied. It was weak when that number came out. Yesterday you had an opportunity again to buy that dip. Some of my subscribers got annoyed. They're like, Mike, you're telling us to buy the dips, and we had a 3.3 million weekly unemployment claims? Are you serious? I mean, so I had to explain again, look, there are the markets, and then there's society and the economy. And sometimes they diverge. And markets tend to be discounting mechanisms. What I mean by that is that they reflect people's expectations and forecasts and stuff like that. So everybody knew, we had this tremendous collapse in the market, in many ways equal and in some ways even exceeding the 1929-1930 market crash. So that discounted a lot. In other words, what does discounting mean? It means the market already reflected a high degree of pessimism, a belief that the economic situation would become dire, and we saw the number. The number was a dire number, but all right, the markets crash since, when did we peak out? February or something like that? The markets crash until now. I mean, this has been my premise. You could, you can accept it or not. I have subscribers who say, Mike, I'm short. You were right, Mike. I should have bought, but I'm short. This is my premise, that it has discounted at least the current situation. And sentiment is still very, very bearish. It's still very negative. So the market is going to go up more. Now, when you look at this so-called stimulus package, and I want to talk about that for a second, a particular part of it, which makes me so angry. All of it really makes me angry because it's loans. Those small business SBA loans are at 11.5% interest rate. Come on, it's like usury. Everybody like, the government should be like work like a profit-seeking enterprise. Well, okay, this is what happens when the government works like, the government should be run like a business. The government should be run like a business. We need a businessman. This is what happens. You get a government profiteering off of its citizens for its own money that it creates. I mean, it's ridiculous. Anyway, a lot of this stuff, really the only free and clear asset going into anybody's pocket is this $1,200 check and the unemployment insurance. That's it. Everything else is loans. And some of these loans first of all, the SBA loans to the small business, they come with a huge interest rate. The loans to big corporations, a lot of it, hey, we're going to take an equity position now. We're going to be part owners. I mean, the government put everybody into this situation when they shut These were not, like I said before, These were not failing businesses that got a bailout and then, yeah, the bailout comes with an equity position. I can understand that. These were viable, highly profitable companies, Delta, United, all these, that were thrown into this by these shutdowns. Anyway, what I want to talk about, which makes me furious, all right, is about 20% of this so-called package, $425 billion, is being given to the Fed. Now, think about this. $425 billion of our money, taxpayer money, is being given to the Fed, which the Fed will then leverage up, according to Mnuchin, to 10 times. So that $400 billion, the Fed will make up to $4 trillion in loans off of that. All right, now here's the thing that rankles me to no end. Number one, the Fed doesn't need a capital infusion to make loans. And that is by virtue of the fact that the Federal Reserve Act grants the Fed the ability to lend in any quantity to anyone that it wants. And the proof of the pudding is, since September, we have seen the Fed lend in the trillions upon trillions without any capital infusion from us, from the Treasury. So, this is just craziness. By the way, that $400 billion, that could be you could literally give almost every single person in the United States 300 million, like 330 million. Let's just call it 300. Almost every single person in the United States could get a $1,500 check. That means babies to old people with that $425 billion. But these geniuses are given, I guess that they think it's like a capital infusion. Fed, take our $425 billion and then leverage it up to $4 trillion. Meanwhile, what did they just lend out? Like 20 trillion or something like that without any capital infusion. So I just want you to understand that these clowns, these idiots, these morons who are running the show over here. Like it is unfreaking. Oh, here's the thing I wanted to really talk about. Well, I wanted to talk about that thing I just talked about, but there was, and I stand corrected on this. You know me, I kept saying, show me evidence of a dollar shortage. Show me evidence of a dollar shortage. Don't just show me, hey, the dollar's going up in the foreign exchange market, because that could be speculative. That could be portfolio flows. We've seen that in many markets over the years. I kept saying, show me evidence, because remember, in fact, last Friday when I did my video, I said, look, the Fed's own Forex swaps, the central bank liquidity swaps, which the Fed uses to supply dollars to other central banks, which those other central banks then turn around and lend those dollars into their systems if their systems are short dollars. I kept saying, there's nothing in there. There's nothing in there. Last week, in the latest week, when the Fed actually made an announcement that they were expanding those swap lines to a broader group of central banks, they were increasing the frequency of those swap lines. There was, remember, I said 45 million in there. Well, guess what? In today's H.4.1, their weekly release, those swap lines went up in the last week. That's the week ending yesterday, March 25th. They increased by 206 billion in 1 week. So I stand corrected. There was a dollar shortage. We went from basically zero to two. And by the way, that 206 billion increase in 1 week, that was the biggest increase ever. That was the biggest 1 week increase ever. You could go all the way back to the 2008 crisis. And now the swap lines are at the highest level since, I believe it's like August 2009. So the highest level in 11 years. So yeah, there was a problem. I stand corrected. But I've always said, I go with the numbers. I want to see the evidence. I want to see the proof. I don't just want to see, hey, the market's moving, then automatically that means something. No, it doesn't always mean something. But in this case, it did. And I see the evidence now, so I stand corrected. Anyway, dollar is falling back down again now. All right, everybody, go to my website, pitbulleconomics.com. Learn, improve yourself, raise your game, get some mental game. See everybody tomorrow. Bye-bye.